Welcome to the Solo 401k versus self-directed IRA wealth building strategies session. Today, well, first off, my name is Brett Sininsky. I am a Solo 401k and self-directed IRA consultant here at Sense Financial, which actually happens to be the only two products that we offer. As such, we are able to do that at a very high level because of focus. And Dimitri, the founder of our company, who started the company in 2010, has along the way been exposed to many different shiny objects and ancillary add-on type services that he certainly could have said yes to along the way and probably made a lot more money doing so. However, he chose to say no to those shiny objects simply because he wanted to focus on providing the highest level service possible to as many people as possible without the dilution of offering a bunch of different things. So we specialize in the Solo 401k and the self-directed IRA, and we'll break down how you can use those two products to self-direct in this webinar. So again, my name is Brett Sininsky, consultant here at Sense Financial. We're not a fiduciary. This is educational only. We're not here to provide tax, legal, investment, accounting advice. If we do talk about a possible opportunity to invest, do your own due diligence. We may just be making an introduction of some sort. If you do need accounting or other expert legal advice, please seek out the services of that competent professional. Our mission here at Sense Financial is to help clients obtain control and protect their retirement account. Proverbs 21:5 says, "Good planning and hard work lead to prosperity." And you work hard for your money. We want to come alongside you and work hard for you as well in helping you with our mission there, and ultimately retire with dignity and be able to just have the retirement you'd like to have in your time frame. Well, why should you listen to us? Well, I guess there's a few reasons. One, our clients love us. I mean, truthfully, this is not a toot, this is not to be braggadocio. The fact is we have a lot of 5-star reviews on Better Business Bureau, Google, Trustpilot, and other places. We've been in business, as I mentioned at the beginning, since 2010, and we have well over 3,000 clients, and we've helped set up well over 4,000 different self-directed retirement accounts for those clients. And I want to take a second here and read a quick testimonial. This is actually from Trustpilot, and this is in relation to our client portal, which I'll talk a little bit about later as well. But our clients have access to what we call our client portal, and within this client portal, there is a knowledge base. Any question that we've been asked as a company more than a handful of times is in this knowledge base. We believe in creating not only the best customer experience, but also a streamlined process for everybody. And so from an engineering standpoint, if we have to do the same thing over and over again, we might as well put something a little more automated in place in the form, in this case, of a knowledge base or frequently asked questions. And so this review, 5 stars on Trustpilot, says, "I used the client portal in search of information on setting up a Roth account with my existing Solo 401k. I used the chat feature that popped up and shortly got a call from Dimitri himself. He immediately identified my problem and not only suggested a perfect solution, but sent me all the links and introductions needed to get me set up quickly and easily. Fabulous customer support, and what a wonderful website packed full of easily accessible information and knowledge." And so I wanted to share that real quick just to give you an idea of what our clients think about us. And that's just an example of, just why you should listen to us. And I'm going to get through more of that, I promise. First off, what is conventional? What is self-directed? Well, obviously, we're here to talk about self-direction into alternative assets. But first off, let's identify what conventional means. And I'm going to use an analogy. On the left, you see a bus. It's attached to a wire up top. It's attached to some tracks that it has to stay on. You have to physically get to a particular location. where the bus is going to stop, and you can get on, and then it's going to take you to certain stops along the way. And then you have to walk from the stop to your ultimate destination. It's restricted to the track, to where it's supposed to go. It's preset, it's pre-designed to go a certain route and stop at certain locations. That's your conventional side of investing: stocks, bonds, mutual funds, ETFs. So think about Vanguard, Fidelity, T. Rowe Price, Edward Jones. Nothing against them, but that's the conventional side. And then on the other side, you have the off-road vehicle. Now, this vehicle can go just about anywhere, right? It can go on where the bus can go. It can also go off-road. It can go on the road anywhere it wants to go. It can go over sidewalks if it has to, if it wants to. Not that you should drive on a sidewalk, but theoretically it could. It has a higher clearance to be able to do that. It could go over small rocks. It could go up hills, down hills. It could go through some water, and virtually anywhere you want to go. Now, there's still some rules to follow, or else you could get hurt, right? You're still gonna wear your seatbelt. You're not gonna run, speed necessarily. I suppose you could, but you probably shouldn't. But there's still some more flexibility on that side of the equation, and that's the self-direction into alternative assets that we're going to focus on today, such as real estate, cryptocurrency, precious metals, private lending. You can become the bank, and actually your 401k or your IRA could become a bank and lend to people who are, let's call it fix and flipping, or doing short-term rentals, and they need some cash, and they can pay you a return on that loan. Tax deeds, virtually no limits. In fact, the IRS actually has said what you cannot invest in. There is no list from the IRS that says what you can invest in, only what you cannot invest in, which is good for us because it allows creativity. And those restrictions are life insurance and collectibles, and we'll talk more about that down the webinar a bit. So I want to give a little bit of an example, a real life example. Okay, Brad and Jennifer out of Phoenix, Arizona. Yes, the names and the location are changed to protect the innocent. Brad and Jennifer are a real estate family. They're a real estate team. Along the way, they had W-2 jobs and amassed a fair amount of money in the 401ks there. That ultimately became IRA, 401k rollovers, and wanting to invest in what they were doing, which was helping people acquire real estate, both for investment purposes and also the place that they call home. They wanted to, and they found out, Brad did, and Jennifer, that they could invest their IRA, not only their IRA, but actually, because they're self-employed, their solo 401k. And so his goal was diversification. So we established a solo 401k for them, and they started contributing and rolled over some money from those current qualified retirement accounts and started buying real estate, multifamily and rental properties, primarily in the Roth 401k. And so as a result, they quite literally have millions of dollars of real estate inside their Roth 401k. Why do I bring this up? Well, not only for a real life example of the power of this, but also to emphasize the power of the Roth Solo 401k. Now, the Solo 401k, I'll talk more about this, has a Roth and pre-tax component built in, whereas the self-directed IRA is either a Roth self-directed IRA or a traditional pre-tax self-directed IRA. So that's one advantage of the 401k over the IRA, which we'll talk more about. I digress. They were able to put all this money into the Roth. So yes, the contributions are taxable contributions. In that year, the contributions are made as earned income, but now all the gains, the income from the rentals, the appreciation when they sell the rentals, or when the 401k sells the rentals, are going to be realized completely tax-free. So that's the power of the Roth. Okay, so I kind of hinted at this. We have two options here at Sense Financial. We have a self-directed IRA and a solo 401k. So when somebody comes to us and they get on our calendar, generally speaking, they're looking to do more of what they're already doing. For example, many of you on this webinar are probably real estate investors of some sort, right? Maybe you're doing private lending, maybe you're doing syndication, maybe you're buying and holding rental properties. Many of our clients are already doing that. And then along the way, they find out that they can do that in their retirement account. And so they do some research, some discovery, they get on our calendar, we find out, okay, what do you want to do? What are your goals? What do you have for current investments, the balances, Roth versus traditional? And then, are you self-employed? And if they're self-employed, we talk about the solo 401k if they don't have any full-time employees outside of themselves and a spouse. And if they are not, we talk about the self-directed IRA. And so the self-directed IRA, the reason for the visual with all the different people there is because anybody can do a self-directed IRA, right? The contribution limits are a little lower, so 99% of the time, our clients are transferring in existing qualified retirement account into the self-directed IRA to be able to then invest that IRA into alternative assets. But you don't need that much to start, $10, $15, $20,000, give or take, to get started in, let's say, private lending as an example. Whereas the solo 401k, a lot of people just fund it from contributions. You can roll over qualified retirement account money into the solo 401k, but the contribution limits are so much higher, and we'll talk more about that. But just suffice it to say, the 401k has 10 times the amount of annual contribution limit allowed versus the self-directed IRA. So you theoretically could start out at zero in the 401k and just fund it from contributions as opposed to actual rollovers. So how does the checkbook IRA work, and why am I calling it a checkbook IRA? Well, let me answer that question through a diagram here. First step is, once we determine that you not only should do a checkbook IRA, but you're ready, willing, and able to move forward with us, is you're going to open a new account. We're going to help you with this with an IRS approved custodian. This isn't just any custodian, because Vanguard, Fidelity, T. Rowe Price, my examples at the beginning, are also custodians, but they don't allow for alternative assets. If you have your money with them, you're stuck investing in with what they offer. Again, nothing wrong with that, but it's not alternative assets. It's the stock market in one way, shape, or form. And so we open the new account with the IRS approved custodian. Then a qualified transfer is set up, typically, like I said, and that's from an existing IRA. Could be Roth, it could be traditional, could be both. Again, with the IRA, it's either a Roth self-directed IRA or a traditional self-directed IRA, but nevertheless, you could do it with either one. It's a 401k, usually from a former employer. There are some exceptions to that where you can do what's called a in-service rollover. If you're over 50, you can ask the question, which essentially means you're still employed at that W-2 employer. You don't have any intention of leaving them, and you're over 50, but they still allow for you to do that in-service rollover, meaning you can roll over some or all of your 401k contributions into another qualified retirement account. So it's worth asking the question if you're over 50 and you want to self-direct some of that money. And then the 403b, kind of the same idea there, but you don't have to do that, right? Nobody has to roll over anything that they don't want to roll over. You could keep it there, but those are just an example of step number 2. So the qualified transfer set up after the custodial account is opened up, and then a special purpose LLC is formed. Now, this is key here. This is why it's called a checkbook IRA or IRA LLC. The LLC is special purpose. It's designed primarily and specifically to be owned by an IRA. It's so that's the IRA is the single member, and you are the manager. That little guy there with his hand up, that's the manager, that's you, which gives you the checkbook control. It gives you the check writing authority. It gives you the ability to make decisions from a fiduciary responsibility on behalf of your retirement account. Your retirement account is not you. You are not your retirement account. It's separate. Your sole purpose of managing it is to make the best decisions for the retirement account as if it were somebody else's money that you're managing, even though it's for your retirement. So the single member LLC is formed. You're the manager of that LLC. And then because you are the manager of that LLC, not only can you write checks and make investments and make decisions like that, you can also open up accounts, right? So with that, the bank account is opened, the LLC is funded, the IRA buys 100% of the units of that LLC, and now you have this checking account. This is where the term checkbook IRA comes into play. So this checking account, this goes for the 401k and the IRA, is the home, if you will, for the funds. Okay, so until they're deployed into an investment that you choose, the money's sitting in this checking account, right? You write checks out of it, you do online bill pay, wire transfer, ACH, whatever you choose to get the money in and the money out. Now, one thing that's really important when you start making those investments is that all the income and all the expenses is is going into and out of that LLC, right? It cannot go to you personally. It cannot go to another checking account you have that you own personally. It has to be all in the name of the LLC. And that's really important because you cannot commingle the funds. That could cause a distribution or worse. And it could cause actually the whole IRA to be disqualified. And you don't want to deal with that. So um, we'll help you with that. It's not something that happens too common. In fact, I haven't really heard about it happening at all with one of our clients. But I just want to make that clear is that all the income and expenses must go into and out of that LLC. Now, we're going to transition to the solo 401k. I'm going to spend a little more time on that because the solo 401k is the superior product here. Who's it for? As I mentioned before, it's for the business owner and their spouse primarily. And but you don't have to be just a husband and wife. You can actually have a partnership, and you could be set up as a sole proprietor. You can be a S corp, single member LLC. It doesn't matter. You can, as long as you have legitimate self-employment activity, you can qualify for a solo 401k. Again, as long as you don't have any W-2 employees outside of yourself and your spouse, full-time W-2 employees. And so if you check those boxes, meaning you drive for Uber one day a month, you're a real estate agent, you sell a house every other year, or you do it regularly, whatever. I'm just using those examples because it doesn't take it just takes legitimate self-employment activity to be able to qualify for a solo 401k. So this is my silly example of like a home inspector, husband and wife, if you will, that are, running a home inspection team. And we have a lot of clients in real estate. So that's why I'm using this as an example. So how does it work? Okay, another diagram. Well, first off, there has to be that plan sponsor. I touched on that already. Sole prop, corporation, LLC, partnership, etc. That company, that self-employment company sponsors the 401k plan. Just like if you worked at Walmart or you have a W-2 right now, then that company can sponsor a 401k plan for all of its employees. It's the same thing here. It's just your own business. So the plan sponsor adopts the plan, and the trust is created. All the assets are in the solo 401k trust. Okay, you're the trustee. This is what gives you the checkbook control within the solo 401k space. And so again, just like the IRA, as the plan trustee, you have the ability to open accounts, bank accounts, brokerage account. You can go to Vanguard and open a brokerage account in the name of the solo 401k and invest in the S&P 500 or money market or whatever they offer. And then on the other side, you can simultaneously within that same 401k plan, you can do alternative asset investing, such as real estate, private lending, some of the examples I mentioned earlier. And just like the IRA, the money must go into and out of that solo 401k trust. So the checking account is the home for the money until you deploy it into alternative assets. How do the contributions work? Well, it's actually up to $76,500 per year per participant. If you're over 50, if you're under 50, that number is $69,000. Proverbs 21:20 says, "The wise man saves for the future, but the foolish man spends whatever he gets." We don't want to be foolish. We want to set money aside for the future, for sure. As a self-employed individual, you wear two hats. You wear the employer hat and you wear the employee hat. This is actively earned business income. You're working on the business and you're working in the business. Because of that, in the solo 401k, the IRS allows you to have two separate buckets of contributions. One is as the employer, you can contribute up to 23,000 under 50, and then a catch up of 7,500, so 30,500 if you're over 50 on the employer side. Now that side is super cool because it can be up to 100% of what you make, right? There's no percentage. I'm bringing that up for a reason, and I'll tell you why in a second. But That's how the employer side works. Okay, 23 or 30,500 if you're over 50. And then the way you get from those numbers up to 76.5 or 69,000 is by the profit sharing, the employer side of things. On the employer side of things, you can contribute roughly 20% of the net profit or the total payroll of the business for the year. Okay, and that's how you bridge that gap between 23 and 69 as an example. Now, if you are contributing to a W-2 401k, you cannot double dip on the employee contribution, the 23. If you're not maxing that out at your W-2, you can contribute the difference to your solo 401k, but you cannot double dip the same money, right? If you're maxing it out, you can't do the employee contribution also on your 401k for your self-employment. Now, you can go from 0 to 69,000 on the profit sharing alone. So if you make enough money for 20% to get up to 69,000, but you also have this W-2 job, you could be putting 23,000 away at your W-2 401k and another 69,000 pre-tax or Roth into your solo 401k. So that's how the contribution works. By the way, I just want to encourage you guys, I will give some time for Q&A at the end. I see one from Sri already. So yeah, keep those questions coming. Thank you very much. I will definitely give time for that at the end. And so the reason checkbook control is kind of a super cool component to this. Not every custodian allows for checkbook control, especially with the IRA, but all of our plans do. We believe that it's just an easier, more effective way to manage your retirement account, primarily and especially if you're going to be doing a fair amount of transactions. Because if you don't have checkbook control, then you have to go through the custodian for all the deposits and all the transactions, all the documents, agreements, contracts, offers, all that has to be signed by the custodian. And so you're going to have to go through them through their online portal, whatever it may be. So that's going to cause some time delays, some red tape. It's going to also cause some additional transaction fees, typically, depending on what kind of package they offer that you are bought into. But with Sense Financial, we have one flat annual fee, covers everything. It's a flat $250, and you can do as many transactions as you want. Okay. And we don't hold any money. I want to be clear about that. You have control over your money. It's a third-party checking account that you own, just like your personal account, rather your retirement account owns, but you have that access to it through the LLC or the solo 401k trust. And so we don't hold any money. There's no asset-based fees or transaction fees or anything else here at Sense Financial. So with checkbook control, if you go to a real estate investment club and somebody's pitching a wholesale deal and you want to buy it, not personally, but in your 401k or IRA, you could bring your checkbook along and literally write a check right there on the spot. If you had to go through the custodian, there's going to be 24, maybe 48 hours, but probably not between you getting that money to that wholesaler versus, and by then the deal may be gone already, right? So having checkbook control can be very advantageous. And furthermore, within the retirement account, you can actually buy real estate with leverage. Okay, so think about it like this. The S&P 500 is great long-term, right? Maybe 8-10%-ish over time. You can get much higher returns on real estate. And primarily, you can get much higher returns on real estate if you use leverage. Okay, the property's got a cash flow. When's the last time somebody gave you a loan to buy more stock, more S&P 500? Like, it just doesn't happen. But there are people lining up to loan money to investors to loan so they can buy real estate, or their IRA can buy real estate. Now, inside the retirement account, the property must cash flow, couple hundred bucks a month. You're going to have 40 to 50% down. You're going to have some reserves. We have a list of the different lenders that are called non-recourse lenders because they have to be non-recourse, which means the property is the only security for the loan and you cannot provide a personal guarantee. So if the retirement account defaults on the mortgage, then the only thing the lender can go after is the actual property and foreclose on that. They're not going to ding your credit or anything else. So non-recourse, that's what that means. Now, inside of an IRA, it will trigger UDFI, which is called unrelated debt finance income. So that's something to be aware of on the income portion of the real estate that is derived because of the mortgage. So if it's 50% down, 50% mortgage, 50% of the income is going to be subject to UDFI, which is going to trigger UBIT or UBIT, unrelated business income tax. And that scales up to 37% around the $12,000 mark after subtracting the first 1,000 depreciation and expenses and such out of that 50% in my example. So don't be scared of it, but it's something to be aware of and plan for that your IRA may have to pay the following year in a tax return. Now, the reason I bring that up is because the solo 401k does not have UDFI on leveraged real estate. So there's no UBIT on leveraged real estate. But you can visit that URL. We have 6 or 8 different lenders on there that are non-recourse. They all have, some different terms and programs that you can consider if you're going to get a loan on real estate within your retirement account. Okay, disallowed investments. So I mentioned life insurance, and that's kind of my example on the right there of somebody administering a life insurance policy to a family. But and then on the other side, you have collectibles. Now, the life insurance restriction is only in the IRA. Collectibles is for both. And so what are collectibles? Well, you see my example there of baseball cards, stamps. There's, believe it or not, there's like some stamps mixed into that diagram there. Cars, exotic cars, anything that's going to be a collectible, paintings, art, that sort of thing. Even something that people have been asking about lately are NFTs. There is a way to categorize an NFT so it's not a collectible, but it's a passive investment. That's something you would have to seek advice from a competent tax advisor that understands self-directed IRAs. But otherwise, NFTs are going to be collectibles as well. So those are the disallowed investments. Furthermore, anything that would create a prohibited transaction, which not only are the disallowed investments, but also disqualified persons. So the lineal descents, you, your spouse, your children, their spouses, your parents and grandparents are all disqualified persons to the retirement account. What does that mean? It means they cannot invest. They cannot personally benefit from anything the retirement account is investing in. An example would be on that is if I'm a real estate agent, I have my real estate license. I cannot go and represent my 401k or IRA in a real estate transaction. Even if I didn't take any commission, I could credit the whole commission as a closing cost credit to my retirement account. It doesn't matter because I can't do that type of work on behalf of the retirement account. So think about it like this. You can't get compensated and you can't do that work. So it's blue collar work you can't do. It's an easy analogy. White collar work is okay. So anything kind of behind a computer. I like to say you can hire the person that's going to swing the hammer, but you can't swing the hammer yourself. Okay. So that's a good example. Also, you can't benefit from anything the retirement account owns. So another example of that would be a rental property. It doesn't matter if it's short-term, long-term, whatever. If you own a rental property in, I don't know, a college town, for example, and your daughter or son is going to go to college in that town, they can't stay there. They can't benefit it. Even if you charge them full market rent or more, it doesn't matter. They can't benefit from it. They can't stay there. You can't go stay there. None of those disqualified peoples can do that. So a couple of kind of real life easy examples to understand how the disqualified persons come in to play that would create prohibited transactions. So this is just a diagram of a traditional self-directed IRA. And what I mean by that is not traditional in the sense of pre-tax, but traditional in the sense of no checkbook control, where you have to go through the custodian. So that's the example on the left. And then in the middle, you have the IRA LLC, which is what we spoke about. We do at Sense Financial. And then on the right, you have the solo 401k. And so you can, if you want, grab a screenshot of that or just view it real quick, but you can see the differences in one shot there of the IRA versus the 401k. And obviously the biggest difference is the max contribution, no UBIT on leveraged real estate, and also self-employment required, of course, for the 401k. But another big one is that the 401k, and we didn't talk about this really, is that it has a built-in Roth component. So in the 401k, you have traditional and Roth all built into one. And I did say earlier that the IRA is either one or the other or both. So if you have a Roth IRA you want to self-direct and a traditional IRA you want to self-direct, you need to set up two separate self-directed IRAs. And with the 401k, that's not the case. It's just built in. And people get confused about how to delineate the difference because of the checkbook control aspect and everything. Well, it's actually really simple. And first of all, we're here for unlimited client support, as you saw in my example of the testimonial I read earlier. So I want to get that out of the way. If you have questions and you're a client, even if you're not a client, reach out to us and we're going to help you. We're going to answer questions. Okay. But especially for our clients, we offer unlimited client support. The reason I bring that up is because if you have been making traditional contributions all along to your 401k and you want to start making Roth contributions, well, first of all, you can go on the client portal at 3 a.m. if you want and look at the article that we have about how to do that I think covers everything. But if you have questions beyond that, or you don't want to deal with that, you want to reach out to us directly, you're more than welcome to. And so the Roth is built in, pre-tax Roth contributions in the 401k. And again, the whole thing can be Roth, right? You can put in the entire amount of $76,500 as long as you can afford the tax hit on that. But the other thing I didn't talk about, I'm going to touch on, and then I'll wrap this up, is the fact that you can do a Roth conversion too. So you can take pre-tax money and you can actually convert that into Roth. That could be done. Actually, that could be done at your current custodian. So if you have a traditional IRA at Vanguard, you can actually convert that into a Roth IRA at Vanguard. In fact, we encourage you to do that. Even if you're going to self-direct, convert it there first and then turn it into a Roth self-directed IRA. With one caveat, the Roth IRA is the only type of qualified retirement account currently, this may change in the future, currently that cannot go into a 401k. So if you have a Roth IRA you want to self-direct, it has to stay an IRA. It cannot go into the 401k. So my example of taking a traditional IRA and converting it into Roth in the current custodian, if you qualify for a solo 401k, you need to, if you want to do that, you need to move that traditional IRA into the solo 401k first and then convert it to Roth. That way it stays in the solo 401k. It's not stuck as an IRA. Okay. And so all in one and just easier to maintain, solo versus IRA, and no UBIT on leveraged real estate. There's a lot of reasons why you would do that. We do have a free ebook that Dimitri, our founder, wrote called the IRA Makeover. It covers the 401k and the IRA, and you can go to that URL and download it for free if you'd like. And then my last offer is if you want to get on my calendar, you're more than welcome to. Actually, it says 15 minutes. I have it set up for 20 now. And there's some cushion there too, but we'll get on, we'll talk through your situation. It's not a sales call. It is an educational call. If it makes sense for us to do business, great. If it doesn't, our goal is to provide value regardless that you can take with you for immediate implementation or down the road knowledge. So happy to talk to any of you at any time. Just go to that URL, book a call, and we'll go from there. With that, I'm going to turn it over to questions. And so it looks like there are a couple. Take a drink of water first. Sri, thank you for the question about the traditional. So Sri asks, the limits you are sharing, is that for traditional or Roth solo 401k? Yeah, the answer is both. Now, I will say, Sri, it's logistically, it's a little different how you make the contributions. So again, you have the two buckets, right? You have the employee contribution up to 23, and you have the employer contribution up to a maximum of 20 or 25% if you're an S Corp of the payroll or the net profit of the company. Okay, so easy example, you make $100,000. let's say as sole proprietor, you net 100,000. Now, out of that 100,000, you could put in 23, and then you could put in about another 20,000 on top of the 23. So now you're at 43. Okay. Now you're not at the max yet, but that's because you didn't net enough money. So you put in the 43. Now, the employee contribution, the 23, that can go straight in as a Roth contribution. Okay. Nothing to do with that later, other than, it's going to trickle down to your tax return as income, right? Because it's a Roth contribution. So, you'll loop your CPA in on that, of course. And then on the profit sharing side, that's actually going to go in as a pre-tax, but then you're going to 1099 yourself for that income personally, because it has to move to your 1040 in order to become taxable income. So it becomes a Roth contribution. So the company, it's a business expense for the business as a profit sharing contribution. But then if you want to make it Roth, you literally do that like the next day. And then at the end of the year into the new year, you'll 1099 yourself for that money. Okay. And that's how it becomes Roth, because you're paying your ordinary, whatever your tax bracket is on that. So hopefully that helps. And then another question about, will this be recorded? Yes, we will absolutely send out the recording, no problem. And it comes out, it'll be maybe by tomorrow at the latest, after it gets all rendered and figured out there. And those are the only questions. So either you guys are quiet today, or I just did such a good job, I don't know. But yeah, I'm going to give it another 30 seconds or so here. If anybody else has any further questions, please feel free to ask them. All right. Well, with that said, I'm going to wrap it up. Thank you so much for being here. We appreciate it. Again, if you want to chat, happy to. No pressure at all. Thank you so much. Oh, I got another one. Oh, now the questions are coming in. Okay. Right when I say I'm about to wrap it up. That's all right. Thank you. Dion, hope I'm saying your name correctly, says, why would someone choose a Roth? Well, a Roth contributions are made with tax money, with after-tax money, but all the income derived from the investments, the interest, the appreciation on real estate as an example, all of that is tax-free, right? So everyone's situation is different. You have to talk to your CPA about what that looks like, and does it make sense to pay the taxes now versus at retirement. You'll hear the argument that your income level will be less when you retire, so you'll be in a lower tax bracket. So let's just save on the taxes now and grow the money tax deferred and pay the taxes at retirement. I don't know. I want more income when I'm retired than I do now. So that's my goal. Whether God allows that to happen or not remains to be seen, but that's my goal. And I don't think taxes are going to be lower when I get to retirement time. I'm 45, so I've got a bit. So that's why you would do that. Tax-free money at retirement versus taxable money at retirement, primarily. But it depends on your situation. So hopefully that answers that. And then are contributions limited by our earning level? Tom, good question. No, they're not. Not in the solo 401k. You can do Roth all day long. In fact, you can do a backdoor Roth even if you make over the income limit to do a traditional type Roth contribution. You just make after-tax contributions and then convert them to Roth. You can seek out your CPA for advice on that. In fact, sometimes you could do that at your 401k with your employer. Just if you've already maxed out your contributions, you can make more contributions over the maximum allowable limit. They're just not tax deferred. They're actually after-tax contributions. And then you can convert that to Roth. In some cases within that existing W-2 401k. In other cases, you have to do it in a more traditional type custodian. Dion says, I'm sorry, I meant Roth IRA over 401k, just the contribution limit. Well, the Roth IRA is 7,000 if you're under 50, 8,000 if you're over 50. So that applies to the traditional IRA contributions and Roth IRA contributions. So hopefully that answers that. All right. By the way, Tom, one more note on your question about limited by earning level. If you have a W-2 401k and they offer a Roth option, there's no limit to your contributions you can make. This is the Roth IRA that has the limits, not the Roth 401k. So it's the solo 401k or your W-2 401k has the same rules on that. So, all right, going once, going twice. Okay, thank you all so much. Have a great rest of your day. Take care.